सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
The last time the RBI's Monetary Policy Committee had announced its decision, which was in December, Radhika and I had done an episode on December 9th, which went into a lot of the details of what the Monetary Policy Committee is, how it functions, and what a rate hike could mean for all of you. This time around, the Monetary Policy Committee has met for 3 days, and yesterday the RBI governor announced another rate hike of 25 basis points. And so in this episode of Macro Sutra, we're going to confine ourselves to this decision, what the outlook is, what the governor said. And so the topic, and crucially, what we're also going to look at is whether it is time for the RBI to stop hiking rates. That's the topic for Macro Sutra this time. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and this is Radhika Pandey, Senior Fellow at NIPFB. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, I know I said that it's a 25 basis point increase in the repo rate that the Monetary Policy Committee has recommended. But could you tell us a little more of the hike, how it compares to previous hikes, and since May to now, what has changed in the interest rate landscape?
Yes, so since May 2022, RBI started hiking interest rates, and if we include the 8th of February interest rate hike, cumulatively there is an interest rate increase of 250 basis points. Before the yesterday's announcement, there were 50 basis points rate hike, and then in November and December we saw that inflation came down below the 6% upper threshold level, which prompted the Reserve Bank of India to go in for smaller rate hikes. There were expectations that interest rate hikes would be slow, and maybe that the RBI would give some indication that this is the last interest rate hike and that the hiking cycle will end at this moment. But that did not happen, and rightly so. So we can discuss about the nuances. But from May 2022, inflation was rising, and therefore the Reserve Bank of India was responding through higher interest rate hike. It went in for a 40 basis points hike in the month of May,
right.
And then there were 50 basis points rate hike, and now we have a 25 basis points rate hike. Globally also, if we see, many central banks are responding to a smaller pace of rate hike because inflation has started moderating.
Right.
That is a noteworthy point, but what is also important is to look at the composition, whether there is a broad-based decline in inflation or is it just driven by a few commodities, and that determines the outlook on interest rate hike, that whether RBI or other central banks are going to stop hiking rates, or are they going to be data dependent and then decide whether they are going to raise rates further or not.
Right. So just to clarify, when we talk about a 250 basis point rate hike, this basically means that before May of last year, because of the pandemic and the what followed the pandemic, the RBI kept rates at a low 4%. Since then, 250 basis point increase means that now it's at 6.5%. That's just to give some clarity. So now on the inflation front, the RBI governor, in his statement, he said that inflation will average about 5.3% in FY24.
Correct.
But in the quarterly breakup that he's given, he's shown that he predicts inflation to actually start rising. So basically he said that in Q1 it'll be 5%, in Q2 5.4%, in Q3 also 5.4%, but in Q4, which is the Jan to March 2024 period, it will be 5.6%. So does this mean that this won't be the last rate hike, that we might see one more?
Yes, that is what is indicated in the RBI's governor's speech, and also in the press conferences, that they are very cautious about inflation at this point in time. because whatever decline we have seen in inflation over the last 2 months in November and December, that was primarily driven by vegetable price decline. Vegetable prices have actually contracted. In December, the contraction was 15%. That means that vegetable prices declined by 15% in December. Also, edible oil prices is another component of food prices that saw a decline.
Right.
But if we look at other sections of the food basket, the prices still remain elevated. For example, cereals, which occupy the major weight in the overall food basket, there the inflation is still 14%. It is rising. Even directionally, it hasn't stopped increasing. It is still inching up, and the wheat prices are rising, and we know the reasons. Entire 2022, we saw export rising, then procurement of wheat fell by 53%.
Right.
Then the government had to respond by imposing export ban on wheat. Wheat prices also, wheat production suffered due to adverse climatic conditions.
Right.
So cereal prices are on the boil at this point in time. Also spices are something which are, though their weight is very small in the overall food basket, but we are seeing a 20% inflation in spices.
Wow.
So cereals, spices, milk. You
Yes.
saw last, I think, news was that Amul has raised prices by ₹3 per
Right.
litre. So milk inflation is 8.5%. So leaving aside vegetables and edible oil, even within the food basket, we are seeing elevated prices. That is about the food. And if we look at core inflation, we've talked about earlier also, it still remains sticky. It is still above 6% and mainly driven by personal care and effects, health and education. Now, noteworthy point is that health expenditure, our per capita health expenditure has increased since pandemic. So if we think of reprioritizing the weights of health in the overall commodity basket, maybe the core inflation will be higher because the expenditure on health has increased over the last 2 years. So these are the things which have warranted a more cautious outlook towards inflation, and therefore while market was expecting that this would be the end of the rate hike cycle, there was no such indication by the Reserve Bank, and they maintain a cautious view, though there was a dissent. So if you see, it is a 4-2 vote. It's not a consensus decision that, there are 6 members of Monetary Policy Committee. 4 voted for a 25 basis point rate hike. 2 voted against this resolution.
Yes.
Meaning that they want the rate hike cycle to pause. So it is becoming complicated because on the one side, growth is slowing down, but on the other side, inflation remains elevated, and the decline that we have seen is not broad-based.
Right. And the RBI governor, in his statement also, he mentioned core inflation a few times. So
Right.
could you tell us a little bit more about what core inflation is and why is he so concerned about it?
So core inflation is when we, in the overall inflation, when we exclude food and fuel, those are the volatile components. If we exclude those, we are left with core inflation.
Right.
And if we look at the CPI basket, if we want to study in terms of the data, which are the categories which comprise of core inflation, we should look at the miscellaneous component.
Okay.
That is one thing, and also clothing, footwear, shelter. These are the things that will comprise, that will give us indication about the core inflation. And RBI governor did talk about core inflation because it continues to remain persistent at 6%. Above 6%,
Yes.
and we know that 6% is the upper threshold of inflation band. So if core inflation remains above 6%, it is a cause of concern for the Monetary Policy Committee, and what the governor said, that they want to break this persistence of core inflation, and therefore they have to raise rates. Now, why this is happening? One thing is that pent-up demand.
Right.
Second thing is, we talked about earlier also, that there is a transmission of input costs to product prices that is happening because now commodity prices are retreating, though they are, again, we are seeing some initial signs of increase, but producers are passing on the prices, the higher input cost to consumers in terms of higher product prices because of increase in demand. So that is the main reason why core inflation is picking up. Services inflation is picking up mainly because of the reason that now because of the receding of pandemic, we are seeing pent up demand and services also picking up. So these are some of the reasons that core inflation continues to remain elevated, and the MPC wants to have a closer vigil over core inflation so that it doesn't go beyond this, and they want to anchor inflation expectation. That is the reason they have a very cautious view about inflation.
Now, when the Monetary Policy Committee has to decide on interest rates, on the one hand, they have to look at inflation, but on the other hand, they have to look at growth. So now in his statement, what the governor has said, that he says that GDP growth will be around 6.4% over the full year of FY 23-24, which is in line with the 6.5 baseline growth that even the economic survey had said. But going into the quarterly data, it shows that growth will be slowing. So in Q1, it's supposed to be 7.8, Q2, 6.2, Q3, 6%, and in Q4, it's supposed to be 5.8%. So now, looking at growth, do you feel that maybe it's time? We'd asked this question in the last episode on December 9th as well. Like, should they start focusing on growth instead of inflation? Do you think that now it's time to look at growth?
Right now, it is time to look at inflation because inflation continues to remain elevated. And as we pointed out that, on growth, we are still durable. We are getting, though growth is slowing, but we also need to look at what are the main sources of growth slowdown. Are there something which is in the remit of monetary policy?
Right.
If growth is slowing down due to, say, domestic demand slowdown, then maybe it is for the monetary policy to take note of that. And to start, a pause on interest rate or maybe cut interest rate. But when growth slowdown is primarily owing to global factors, due to export slowdown, due to uncertainty and instability, which is deterring private investors from undertaking sustained investment, then in that framework or in that landscape, monetary policy cannot do much. Right. So, and even if we look at the high frequency indicators, it gives us mixed signals. The PMI, the manufacturing and services, though there was a slight moderation, we are still in the expansion zone.
Yes.
We look at other indicators, growth is still strong, though it is slowing down, but we are still going strong on growth. Growth is relatively, if we look at, I think it is at this juncture, it is important for the MPC to focus more on inflation, because RBI can contribute towards a sustainable growth by giving a low and stable inflation regime.
Right.
That is very important. That what's the contribution of RBI towards growth? The contribution of RBI towards growth is trying to give a stable, predictable, low, less volatile inflation regime. And that is possible by keeping a close watch on inflation expectations.
Right. And now we have quite a few questions from our wonderful viewers who they go into some of the conceptual issues and, questions regarding the Monetary Policy Committee and the rate hikes. So one of them is the current inflation appears to be more from the supply side imbalance, and most of it is imported inflation, as you pointed out. So isn't the current rise in rates detrimental to growth, as it will severely hurt demand for the short to medium term? Isn't the RBI becoming unnecessarily extra cautious on inflation?
So RBI is cautious, but at this time, as we discussed, it's very important to look at the composition of inflation. And if we look at the composition of inflation, it is still elevated, and we need to see what happens to vegetable prices also, because vegetable prices are seasonal in nature. We are seeing a decline because during winters, vegetable prices do see a contraction. So it may well be it is time to have a close look at the composition of inflation, and till we see a durable decline in core inflation, I think the RBI should maintain a cautious view on inflation. So long as the core inflation continues to remain above 6% and remain persistent at this level, RBI should focus on inflation.
Right. And the next question is, does the rate hike or a reduction get implemented immediately, or does it happen in due course of time? Because in the past we hear from the RBI governor, he says that banks need to pass on the benefits of rate reduction. So it does happen with a lag, right?
It happens with a lag, and depending on which interest rate we are talking about, but typically interest rates start showing their impact within, say, 2 quarters, 6 months. But for example, lending rates will have an impact immediately,
right,
because now most of the lending rates are benchmarked to the policy repo rate, through the marginal cost of lending rate, which we call the MCLR.
Yes.
So most of the loans are benchmarked to repo rate. So if there's a upward shift in the repo rate, the lending rates also tend to increase. So, but the deposit rates are more sticky. They take some more time. So there we see the RBI governor nudging the banks that, you should pass on the deposit rates benefit also
right,
to customers. But banks look at their net interest margin, which is the interest that they get from lending and the interest that they have to pay on deposits.
Right.
So they have to look at their net interest margin and other factors to decide how much they are going to transmit in terms of higher deposit rate. But here, if we look at the recent data, if we look at the weekly statistical supplement data, we have the data that we have is for the fortnight ending 13th Feb. And there we see that the deposit rate is picking up. It was in the range of 9.5%, but now it's risen beyond 10%. So it's now 10.6%. So what we mean to say is that, the gap between credit growth and deposit growth has started to narrow, where because of higher interest rates, credit demand will start tapering off, but the deposit rates will pick up. So it will have their own set of ramifications on the liquidity position of banks and so on.
Yeah.
But yes, we have started to see the impact of rise in interest rates on both credit rate as well as deposit rates.
Right. And now India is part of the global economy and we can't escape what happens in the world. But in particular, there are some events that have a larger impact than others. And so now this question is to do with the US Federal Reserve. And so the question is it correct to say that the US Federal Reserve's rates drive the interest rate hike policy decisions of other countries? If the US starts reducing rates, can we see a similar impact in respect of decisions by other central banks?
Yes. So though if we look at the commentary of central banks, we do not see a mention of the impact of that the Federal Reserve's interest rate decisions are driving our interest rate decision. But yes, they do play a role in shaping the interest rate decisions because the currency also has a role to play here. And if we see that, for example, currently we saw the Federal Reserve also raised its interest rate by 25 basis points. After raising rates by 75 basis points and then 50 basis points and then 25 basis points. So if we have a situation where Federal Reserve is raising interest rate and we here do not raise interest rate, then the interest differential that we see between Indian denominated assets and the US denominated assets will narrow because typically Indian assets are offering higher rates. But if the US interest rate is also rising, this interest rate differential narrows and that will lead to an outflow of capital from India, and that will have implications for our current account balance. So tacitly, I think while making interest rate decision, the interest rate decisions of US Fed is definitely kept in mind because they have an implication on the currency, on rupee appreciation or depreciation, and that will have an impact on current account deficit. That will have an impact on imported inflation because if rupee depreciates, then imported inflation will increase. So these considerations definitely play a role in shaping interest rate decisions.
Right. And a follow-on question from that is that now we've been seeing a lot of news of layoffs in the big tech companies, especially in the US. And so the question is this enough evidence to show that the US is, one, moving towards a recession, And two, because it's moving towards a recession, are we likely to see that they will stop with the interest rate hikes, maybe even reduce interest rates in the future?
So on the contrary, if you see the latest job markets report, it showed that the employment rose by 5.2 lakh in January. So if we look at the non-farm payroll employment data, it shows that the labor market is going very strong. Employment is rising. Unemployment rate is falling. So in fact, the Federal Reserve announced its policy decision on February 1st, and then on 3rd February, this labor market data came out, this jobs data, which is the non-farm payroll employment data, which showed that employment has risen by a substantial amount. And after that, we again had a speech from the Fed chair, Jerome Powell, indicating that they are not yet done with interest rate hikes because labor market is very strong. They would like to see some slack in the labor market, but labor market is strong, demand is strong, so they are not done with interest rate hikes. And though interest rate hikes would be smaller, the terminal rate, beyond which they stop hiking interest rate, would be higher. So those were the kind of indications given to the markets by not only the Fed governor, but by the other Fed Reserve officials also, that this is not the end. And in fact, in 2023, they are not going to cut rates. They may pause rates in the second half, but in the coming few meetings, there could be more rate hikes because the labor market is strong. Now, coming to the layoffs question, what we need to understand is that layoffs we need to study in the context of 2020 and 2021. What happened during that time? Now, during that time, because of work from home, because there was a huge spurt in demand because of the fiscal package given, there was an increase in the hiring spree during that time. After that, with inflation rising, with cost of business rising, firms started rationalizing. They started rationalizing their costs, leading to...
they found that they'd overhired.
They've overhired. They have admitted that they misread the state of the economy. And now that the demand is falling because of higher inflation, they had to lay off. So that is the reason, that's the background behind the laying off by these big tech companies. The other part is that even though there has been this laying off, it has not yet got translated into higher unemployment claims. So in the US, there is unemployment claim that unemployed people can ask for. We have in the data, we do not see an increase in the unemployment claims yet. So that means that the people who have been laid off, they think that they will be able to find jobs elsewhere because the demand is still robust. So the labor market is actually is quite puzzling at this point in time, while other indicators are suggesting a slowdown in the US economy, but labor market is still very strong, and that has led the Fed to give an indication that they have to go in for more rate hikes and that monetary policy tightening is not yet over.
Right. And now this is a final conceptual question, and these are terms that we actually hear quite often where people just say them. But basically, what does the term hard landing and soft landing mean in terms of interest rates? How is it determined whether a central bank is going to go for a hard landing or a soft landing?
So hard landing or soft landing is coming in the context of the trade-off which arises from sustained interest rate hikes. So while the central banks are going in for aggressive monetary policy tightening in the form of increase in interest rates, they also want to see that this does not lead to an undue slowdown in the economy. So that is, if it leads to an undue slowdown in the economy, or if it triggers a recession, that is a hard landing. That, you're trying to fix one problem, but you are causing another problem. You have caused a slowdown in the economy. So that is hard landing. So the challenge before central banks is to calibrate interest rate hikes in a way that it does not disrupt the economy. It does not lead to slowdown in the economy.
So that it leads to a soft landing.
Yeah. So that it leads to a soft landing. They need to slow down a bit because, for example, in the labor market, they want to see some slack, but they don't want to have an undue disruption or the textbook definition of recession where there is a contraction of 2 quarters. So that is the challenge, and that is what all central banks want to do, that their aggressive actions on monetary front should not cause disruption or recession or prolonged slowdown in the economy.
Right. So there you have it. The RBI Monetary Policy Committee, they increased rates by 25 basis points to 6.5%. There is no indication from them that this will be the last hike. In fact, core inflation remains persistently and worryingly high, and they're going to keep an eye on this. The RBI governor has said this. At the same time, growth is slowing down, but still remains kind of robust. So the focus should be on inflation. And so going ahead, that's what we have. We can expect another rate hike in the future. Thank you so much for watching.